We're here to talk to you about your entrusted funds and the unique needs and the unique capabilities that pension plans, university endowments, charitable foundations, and other stewards of capital have, investing other people's money as stewards of a chartered trust to provide chartered benefits to successive generations of entitled or intended beneficiaries. That makes you large, purposeful, perpetual stewards of prosperity for successive generations. And this is a new choice for directing investment within our economy. There's a lot of interesting conversations we can have about history, about anthropology, about political economy, and other subjects coming off of this chart of the different choices available for directing investment. But what we want to focus on today is just the fact that you represent, as stewards of capital, a new choice. And your new choice is actually a much more powerful choice because you have the ability to operate at three levels. You can invest at scale, you can invest in equity, and you can invest with a purpose that is more than just setting a price and selling out. This is extremely important for you and for all of us because we are all entering into a new frontier where impact is really the frontier of our prosperity. All investments, of course, have impact, but increasingly we need to be worrying about making investments that have sustainable impacts. Now, of course, the most important thing you need to sustain is the corpus of your entrusted funds and your ability to keep paying out your benefits. But to do that, you're going to increasingly have to focus on change and adaptation to change, not only in technology, but in society, and in economy, and in the environment, and maybe in other ways as well. This, of course, is a paradigm shift from the received wisdom that is perhaps best typified by the mythos of space as the final frontier. You may recall back in 1961, we decided we were going to put a man on the moon, which was pretty revolutionary at that time. A short 8 years later, in 1969, Neil Armstrong took his famous "one small step for a man, one giant leap for mankind." But the step that Neil took was not the leap we were expecting. We ventured out into space expecting to find a vast and limitless new frontier into which we could expand endlessly. But when we got there, all we found were rocks. And so we have the Earth, and it is well and truly ours, but it is all we have. So your new mission is sustaining your corpus and your benefits within planetary limits by worrying about the impact your investments have on a variety of different aspects of life that go beyond just the immediate return to your portfolio. This is going to require you to change your tactics for deploying your entrusted funds. Where you have historically been worrying about exponential growth and maximizing shareholder value through constant additions to assets and earnings that drive up valuations, you're going to now have to start being concerned about more organic growth, about optimizing global prosperity through innovation and good stewardship, and we're going to give you the tools to do that in what we call equity splits. You're also going to have to change your mandates to your money managers. They're going to have to shift their focus from maximizing risk-adjusted returns, whatever that means, to optimizing global prosperity. Instead of worrying about liquidity, we're going to build for longevity. Instead of being fast-paced, we're going to be enduring. Instead of the usual compensation formula that can be reduced to 2 and 20 and 10, we're going to be looking at evergreen equity splits. This is an idea whose time has come, and its focus is on sponsoring values-driven business leaders who are optimizing commercial competitiveness as their core value. We do this by constructing the private laws of ownership for investment, in which you agree the equity splits in a negotiated base case cash flow waterfall. This allows you to align your interests along multiple points of shared value. Some of these will be financial. You have to worry about your corpus and your benefits. Others will be more societal. And here we think you want to think about participating in wealth creation versus participating in wealth extraction. For corpus and benefits, you're going to be looking for programmed performance that can provide principal protection and actuarial earnings with constancy and transparency and a subordination of incentives. You as the investor should get taken care of first and everybody else should follow. For wealth creation, we look at the categories of economic adaptability, earnings integrity, financial authenticity, global community, resource resiliency, and climate stability. Other people will have different ways of organizing where the wealth is that we think we need to be created. But we want you to think in terms of your investment as the activity of sponsoring leaders, and we suggest we start with a going private, staying private transaction where you invest your base case in large, mature companies that are dominating their markets, and the goal is to take these companies out of the Wall Street paradigm. This paradigm works well when you're in this phase in the organic growth cycle where exponential growth is organic growth. And it's also something that goes well where venture capital down here is anticipating the Wall Street exit. Down here, there's all of this various sources of funding for basic and applied research that are anticipating all of this exponential growth. But up here, exponential growth is not really what we're looking for. Here, we're looking for more stable, steady growth, which in fact is a big part of what finances basic research that leads to the next round of economic growth. And one of the things we really want to get you to think about is how sponsoring what we call ownership earnback is going to empower your business leaders to manage longevity properly and the eventual wind down of their business, which allows us as an economy to bring an end to financial overshoot and to break the cycle of boom and bust. We don't have these trend lines projecting exponential growth beyond where organically the commercial markets are telling us things are leveling off. We're not continuing a more stable, steady growth where the commercial markets are telling us that this is a choice that's really kind of past its prime. And we're not having these episodic events where we try to get the booms going, always busting, in a way of trying to artificially create growth. And this is what we mean by sustainability. It's not artificial growth, it's authentic or organic growth. So you get portfolios that are built for the purpose of protecting your corpus and paying your benefits. And here, there's a lot of detail that we can talk about in this chart. We can circle back on that, but we want to just step through quickly what we're showing you here. You start with fiduciary funds being prudently invested, and you go right to questions of what kind of earnings are required to meet your fiduciary obligations. The first is to make up for any losses for inflation. Then you've got to pay out your benefits on a current basis. You have to have the money to do that. Then you have to pay your administrative costs, of course, so that gives you your total cash needed. Then you start looking at what your total earnings are from your investments, and these are coming out currently based on sharing in the profits that these businesses are generating. First of all, you have to recover your capital. You have to take care of your corpus. And you can see here we are recovering capital incrementally over time, which means as you go out over time, eventually you've got all of your principal back, but you're still sharing in the earnings of these companies, and so you're generating a lot of surplus cash flow. And this, you can see this interesting net surplus shortfall scenario. In this particular structure here for this portfolio, you can see there are some shortfalls against your current cash needs in the early years, growing to very substantial surpluses in the out years, and there's some very interesting conversations that we can have about how we weave a cutover to an equity splits type of portfolio into your existing investing activities so that we can manage these shortfalls and how we can actually accelerate the realization of the surpluses for you. But what we also want to hope you see in here is that because you're recovering your capital as the business is making its profits, it's returning to you control over the reinvestment decision and really control over the impact of future investments that you're going to be making. And to talk about this, we really feel that you're going to need to develop a new vocabulary. And we want to suggest that you start thinking about enterprise, the focus of enterprise, as being what we call unique artifacts. We use artifacts in its anthropological sense as the works of human hands, things that people have touched and in some way, shape, or form made them more valuable. And uniqueness is both singular and special. By singular, we mean there's something physical about the artifact that allows you to give it to some people and not give it to others. And so you can charge a price and control who gets it and who doesn't. A perfect example of what is not singular would be air. We can't sell air because it's there. We all breathe it. It's very special, and this is the other feature. For an artifact to be unique, it has to have value that other people are willing to pay for. And one of the ways in which you can begin to maybe get a feel for why artifacts is a powerful word is if we look at climate risk. And here we would suggest to you that the benefit of not killing the planet is not really a unique artifact, because although it is a very special thing protecting our planet, it's really not singular, because either we all save the planet together or we all kill the planet. Well, the planet dies because some of us. It's an all or none kind of scenario. And for that reason, market forces of enlightened self-interest and letting everybody sort of vote their pocketbooks to collectively decide how we're going to handle this is really not going to get the job done. We think that when you're looking at climate risk, you really have to understand that a political solution is needed. And that's where stewardship actually has some very interesting possibilities, because what do you think would happen if we got stewardship capital to take control of our fossil fuel supplies? Let's go back to this little chart about the organic growth cycle and suggest that we had private equity stewardship people taking control of the coal business and then looking to manage this downturn based not on sort of organic issues of when do we run out of coal or when does some other choice become more price competitive under competitive market conditions, but when do we reach a point where at a policy level we want to start shifting out of doing what Jeremy Legat says is managing our retreat from fossil fuels. So by investing in artifacts, you can be selecting artifacts to sponsor based on their positive impacts on public quality of life, like saving the planet. We can get engaged in budgeting discussions about how much of the profits are going to get reinvested in innovation, how much of the cost budget is going to be accepting the costs of dealing fairly with the other people who are participants in the enterprise, and how do we build resource resiliency into the entire supply chain and distribution chain. On a structuring level, we look at financial authenticity. We're not going to be doing the financial overshoot thing, not going to be feeding the boom and bust cycle. And we get to the private laws of ownership for investment. We look at building transparency and integrity into each individual enterprise. For transparency, the first thing we want you to appreciate is transparency reveals the moving parts. So we're going to be looking at the technical parts and the commercial parts and the financial parts and the societal impacts of these enterprises. We're going to have a lot more information to deal with, but we're also going to be able to get much better decisions. So what we have to offer you here is this cash flow waterfall model, which we can circle back and dwell on at your leisure when you'd like to talk more about it. But you're highlighting here the splits between you as the equity sponsor or investor and the business leaders who are the real owners of the enterprise. And you can see in the upper right, as the sponsor, you get your bit taken care of first, and the owner earns back their control of their business by making sure you get the investment you need. At the bottom of this slide, we've laid out a cash flow investor benefit schedule, and this becomes the new sort of image that takes the place of a stock price chart. You're not looking at what's happening to your prices in some sort of an exchange market. You're looking at what's happening to the cash flows that are moving through the enterprise that you are sponsoring and that you are sharing in the wealth creation activities that are going on. For integrity, we offer this other stylized and universally valid view of enterprise, where you've got resources coming in and technology coming in. You've got time, effort, expertise being invested to use that technology to convert those resources into artifacts that generate revenues through commercial monetization. All of this being led by the business leaders who are pulling it all together and keeping it all together. And we can talk on a follow-on basis about how all of this is stabilized by commitments, some of which may be contracted, others may be course of dealing. So there's a lot of flexibility in this model. Of course, what's missing still is investment, and that would be where you come in. And so we're talking about constructing a legacy of financial impacts on your corpus and benefits, but also of societal impacts on creating wealth versus extracting wealth. What will be your legacy?